Fed's decision and the impact of the ongoing U.S. government shutdown, let's bring in Mike Archbold. He's the former CEO of GNC and a trustee for the Committee for Economic Development. Hi there, Mike. Welcome to the program.
Thank you for having me.
Absolutely. So much to talk about. This interest rate cut was widely anticipated, of course. But what will a 0.25% cut do to help bolster the sagging job market?
So, yeah, the hope there is that the interest rate cut will enable investment from businesses and that investment in businesses could help to create jobs, right? So it's interesting because the Fed is really dealing with the tug between its dual mandate of both maximum employment and stable pricing, right? And they're more worried right now about the maximum employment than they are about stable pricing, which is why we're seeing what is really an insurance, a risk management type of move to cut the 25 basis points, which is very different than what the Fed has been in the past, which you'll recall we always used to hear the words data dependent. Now it's more about, well, the perceived downside risk to the labor market, and they want to really focus on that.
And how much bearing would you say would news such as Amazon's mass layoffs just on Tuesday would have had on the Fed's decision right now?
I'm sure it weighed in because I think it's just one of the many factors that would weigh in. But I think it's important to keep in mind that the vast majority of job creation in the United States is really from small and medium-sized businesses. So while the big businesses are the ones that get all the headlines, it's really the small businesses that are in the position to be creating jobs going forward. And interestingly, those businesses, the small and medium-sized businesses, are more sensitive to the short-term rates than they are to the long-term rates.
So returning to your earlier point, because we know interest rates are often used to either spur economic activity or to curb rising prices, and inflation rate right now for consumer prices well above the Fed's 2% target. So does this mean that tackling inflation is just going to take a back seat for now?
I think you're right on, and it really is that tug of war between these conflicting mandates of the Fed. And right now, I think that they don't see as much of a risk for inflation ticking up as they do concern about the labor market. You're right to point out that the inflation is still beyond the Fed's target of wanting 2%. But it's still in and around the 3% rate. It's not, it's not out of control. It's certainly down from what it was, and it's really more about that perceived risk going forward that the Fed is concerned about.
And we really have to bring up numbers, don't we, Mike? Because interest rate cuts are so heavily dependent on data. But because of the government shutdown, this cut was made partially clouded without so much of that federal data tracking the economy. How significant is this then?
So I would say only somewhat, and Chair Powell himself had said, actually, I think it was back in the previous meeting, that when he pointed to the fact that there is a wide variety of both public and private sector data that have remained available, and that given that that the lack of that data would not preclude policy rate cuts or any kind of policy adjustment. So it's important to keep in mind that they also get a lot of information from the local Federal Reserve banks and the participants in the meeting. So they're collecting all of that data from across the country, plus a number of public and private sector data. So they feel they have enough. That said, certainly there's some numbers that are lacking, and we'll be watching to see as those get caught up and whether they kind of confirm the Fed's move or not.
So if they think the data is enough to do this cut, will a continued shutdown impact any future decision to cut rates again? Because we were at first looking at December, but now that's not looking likely.
Yes, so interesting. I think what we have to do is we have to watch, because before today's meeting, the markets were anticipating 3 more cuts of 25 basis points each. In fact, the markets were projecting, I think it was about an 85% probability for a similar rate cut in December. Chair Powell stated on multiple occasions in his press conference today that those cuts are, quote, far from a foregone conclusion. And he repeated that numerous times. So I think that's what wound up spooking the markets, because the rate cut was expected, the quantitative tightening that they did was expected. The only thing that really surprised the market was the fact that Chair Powell really cautioned us against concluding that a December rate cut was definitively in the cards.
So, the focus here clearly is on the job market for now, but then there's also the whole question of consumer spending, and of course there are tariffs looming. How much have the tariffs really put a pressure on prices and inflation in general, would you say?
So Chair Powell was quantifying that today, and he said it was impacting, and that had a small impact on it, on the inflation numbers. But he was quick to point out that when tariffs do get put into place, that they are a one-time step up in rates. So it's not a compounding effect of rates. So it was interesting to get his perspective on that, to say, while there may be a step function from tariffs, it is a one-time step function.